everyone, a very good morning, good afternoon, and good evening to all of you. This is your host for today's session of Daily Stock, in which we are going to look at the quarterly earnings of a media giant, the Walt Disney. We are going to consider its quarterly earnings, the takeaway from those earnings, and its forward guidance, and how these mixed bag of results is likely to impact the share price in the near term as well as in the medium term. And also, we will consider the fundamental aspects other than the quarterly earnings. And afterwards, we will also look closely on the technical side of the story where the Disney share price stands, and how we can utilize its current situation, the current price movements for our profit. Is the share price for today? It is up more than 3 percentage point from the yesterday. The results are not exactly good nor exactly bad. These are kind of mixed. There are profits coming in from two segments, whereas the streaming segment, the Disney Plus, Hulu, and ESPN Plus, these streaming platforms are still in the red, are not really generating profit for the company, but these are the offerings for the future, and it is going to be essential for the Disney to turn around its streaming segment and make it work. For the legacy segment, the profitability is quite good. It's cable TV. The profitable arm is there. Its theme park segment is also bringing in good revenues, even though there is softening of the profit in both the segments, and that is putting the price of the Disney, the share price of the Disney on downward spiral, because if we look at the longer term chart of the Disney share, here you can see that today's Disney share price is almost 20% below what it was trading at 5 years back. So here, notwithstanding this jump of the Disney shares in the COVID period, overall the picture is negative, as its core businesses are losing the profitability factor. The theme park and the legacy cable channel network are not bringing in as much revenue and as much net profit as they were 5 years back. And then on top of that, we have the new offering of streaming platforms which are still in trade, which are not bringing money for the company currently. So there is this twin problem for the Disney to solve, because it will have to show up its revenues in the profitable segment of theme park and cable channel, cable TV, and at the same time work to turn around the revenues from the streaming platforms. And well, if the company wants to be future ready, then the streaming services is where the future is, and there the Disney is still losing subscriber. It has lost more than 12 million subscribers for the last quarter. But if we look at the geographic spread of these losses in total number of subscribers, the losses are much milder in the North America, that is United States and Canada. So that is where major revenue comes in for the Disney. So I think it is also one of the factors why it has been able to reduce its net losses in the streaming segment after implementing the cost cutting measures. So there is this some sort of silver lining. You can say that the company is able to reduce its losses, and maybe if it persists with its current strategy of trying to improve the revenue and cutting down the cost, it might be able to turn around the streaming services and make it profitable in coming quarter. That is the expectation of the market participant, and we will also have to go into the forward guidance provided by the company. Now, as we have seen this share price of the Disney over 5 years, it is currently trading at the lower point. The share were trading this low back in this COVID slump, and we saw this spurt because in the pandemic phase, many people were sitting at home watching TV, so subscriber base of the streaming platform skyrocketed, and that had pushed the revenues higher. But most of the companies have been unable to sustain those heady revenues, and as a result of that, the market has priced in these lower revenues in lower share prices as well. So the company share price is almost half of what it was at the peak of its pandemic phase. Now let's look at the quarters numbers for the quarter ended July 2023. If you look at the highlights of the results, the revenues for the quarter and 9 months have grown 4% and 8% respectively. The EPS for the quarter was a loss of 0.25 US dollar per share. Now, if we take into account the statement of its CEO, is that the company is working hard to restructure the businesses, streamline the streaming platforms, and turn it around, make it profitable. If we look at the quarterly numbers for the company, the cash flow is lower but still good. Its total revenues have gone up 8% in comparison to the numbers of the same quarter in 2022. Now let's consider its segmental results. Now if we consider this period ended 9 months, it is still 1% up. The theme park business is also bringing in good amount of revenue. It is still higher, 13% in terms of quarter on quarter. And if we look at the year on year figures, sorry, this is year on year in terms of the quarter, and these are for 9 months, cumulative 9 months. This figure, there is growth of 17%. Linear networks are bringing in over $6 billion. Direct to consumer segment is still loss making, but here also the revenues, total revenues have grown, though it is still to translate into net profit as the costs are also on the higher side. So the takeaway from these results provided by the company is that its two segments are profitable, are able to hold the profitability even though on the lower side the net revenues are going down if we compare the company's total revenues to couple of years back. So that is there, but still overall, these are the segments where the company is generating net profit. Whereas for the streaming services, it is still in loss. Domestic channel revenues are lower by 4% for the quarter ended 1st July 2023. But if you look at the revenues from the international market, those are quite low by 20%. So for the North American market, the decline is not that pronounced, but for the international segment, the decline is quite pronounced at 20%. Direct to consumer segment is bringing in more revenues with jump of 9%. Of the three offerings from the company, the Disney Plus and ESPN Plus are losing money, whereas Hulu is bringing in the money. Now, we will not dwell too much on the nitty-gritty of these subscriber base, as the main thing to keep in mind is that the losses are reducing in its subscriber businesses. So we do get a sense of possibility in the turnaround of the streaming platforms, and it might be able to turn this segment also profitable in coming quarter, if not in few months. Now let's go into the technical side of the story and let's consider the company's quarterly results. This is the share price of the company. This is the after market impact of the yesterday's share price release, the quarterly earning release. We saw the Disney's share price jumping 3 percentage point higher, and at the moment it is more than 3.5 percentage point compared to the share price seen in yesterday's session. So there is one interesting story. Now, if we look at the charting from the larger time frame, we will get a sense that this is a sort of you can even say a dead cat bounce because the share price of the company has been trading around these $85 level for a while now. It spent a couple of weeks around this same level, consolidating and oscillating in this narrow range. Now, finally, we are getting a breakout of sort on these current levels where it has been able to break above these prior swing high for the first time in almost 1.5 months. So that is something which we can take heart from. And as the company is looking to reduce its losses and it is still profitable in other two segments, I think we can indeed think about the possibility of Disney Plus shares consolidating with upward bias in the coming days. So even if we don't really see any strong rally in the Disney share price in near future, we still have the possibility of Disney Plus consolidating with bullish bias. So we can indeed take our chances and keep looking for the buying opportunity. So for that, the key level to consider is going to be this immediate swing low, the price level of US dollar 85.44, that is almost 6 percentage point away from the current level. So we have to indeed take a significant amount of risk if you are going for a swing trade, because that is the price zone where the Disney has spent considerable amount of time and it didn't really break below this level. It spent a couple of weeks around those levels, and now that we are finally seeing a breakout of sort on the higher side, we can indeed go for our chances if we feel that after due correction, if the Disney's share price holds around these US dollar 88 or 89 price levels and it doesn't really decline much toward these prior swing low. In that scenario, we will indeed have our chances, but not at the current level. I'm not saying that it is going to decline, but simply because the risk reward ratio is not looking that favorable at the current juncture, and that is something which we'll need to keep in mind. Apart from that, the things are indeed looking encouraging for the share price momentum of the Disney Plus. There is the daily time frame chart, and here, if you look at the price trajectory of the Disney for almost a year, it has been finding support around these US dollar 90 per share level, and then it again went on to make a fresh swing low, and now finally here we have the possibility of Disney share price moving past the immediate swing high of $94.48, so that possibility is quite strong. But for that, we will indeed have to look at the optimization of any trade we are going to take, and optimizing means we have to keep looking for the opportunity to buy closer to the immediate swing low, as that is going to reduce the stop loss level, and we will have a better risk reward ratio too. So that's my take looking at the current share price formation of the Nasdaq, the Disney Plus, which has been consistently finding support over this US dollar 85 per share level. And now that after the release of quarterly earnings, we are seeing uptick in its momentum, then I think unless the immediate swing low is breached, we can keep looking for the opportunity to buy the shares of the Disney Plus for the medium term to short term. Not from the longer term, long term picture is still quite bearish. So from the short term to medium term, we can indeed take our chances. So that's all from my side for today's session of the daily stock, where we looked at the fundamental as well as the technical side of the Disney's share price story, and we found that it has been working hard to turn around its operation and make it profitable. So we indeed can take our chances as well while believing in the statements released by the company and expect the management to deliver on its plans. So thank you all for joining in. If you do have any query or any idea to share, do write to me in the feedback, and I'll be more than happy to take the discussion forward. I'll be back tomorrow with an equally interesting share to talk about and work with. Do come back. See you next time around. Thank you all for joining in. Goodbye.